Ideal stocks for your money in times of war. Are war sirens sending you scurrying for shelter now? Heard you saying yes. It is time then to know which stocks are ideal now for your money. Wartime investing is more knowledge than tactics. When a major war rages on, stock markets react. Stocks begin to lose values and move down. At least, so during the initial phases of the war. How long are these initial phases? It all depends on the nature of the war, its intensity, and its likelihood of flaring up further into a bigger conflict. Whatever, financial astuteness calls for shifting your investments to safe stocks. What stocks are safe in wartime economies? Beyond doubt, defense stocks are ideal and safe. Defense stocks are stocks of companies that make war equipment. They perform better during war storms. Stocks of energy companies come next. This is because oil prices move up during wars. Consider what happened during World War I. As the war erupted, markets melted down by 30%. To prevent a major crisis, the markets were shut for 6 months. As trading resumed later after the war, Dow Jones rallied up by almost 90%. The year was 1915. It was the first recorded case that shows how a major war affected the stock market. Turn to World War II now. Strangely, the markets rallied up by 10%. After Germany invaded Poland in 1939, post-Pearl Harbor, American stocks were down by nearly 3%. They recovered and recouped the losses within a month of the Pearl Harbor attack. From there on, right up to the war's end in 1945, the Dow Jones Index appreciated by as much as 50%. The lessons from these pieces of history are valuable. Lesson 1. Markets do not react for the heck of it. Lesson 2. Post-war, markets learn quickly the art of keeping cool and bouncing back fast. These lessons are founded on 2 premises. The world cannot afford to escalate tensions, and the central banks across the world can control market volatility. What should be your stock-specific strategy now, as war sirens continue to blare across many regions? Buy the dip with a selective strategy. Go for stocks of companies that have muscular ratios of profitability and solvency. Identify companies with brawny balance sheets. Pick those companies for the long haul. Cash richness is one vital parameter that should make you decide which stocks to invest in. Look out for stocks of companies that are not tied down by excessive investments in U.S. Treasury bills. Almost always, excesses kill diversification. Prudence demands that you build a portfolio with sensible proportions in T-bills, global blue chips, and highly liquid stocks. This will help your portfolio benefit from upturns, momentary or lasting. Focus on growth stocks, but do not shun dividend-rich stocks. Balance all these categories. Build a well-balanced portfolio. You are then sure to ride out the wartime storm.